Hello, and thank you for joining us today for this Edward Jones webinar, Financial Questions You're Afraid to Ask. My name is Sandy Miller. Before we get going, let me highlight a few of the features on your screen that we're going to be using. On your screen right now, you should already see a video window with me inside. There should be another window with our presentation slides and a third window for our Q&A feature. If for some reason you have any difficulty during the program, you can click on the help icon at the bottom of your screen. That's the black question mark inside the yellow circle. This is for any technical questions you may have. We also have a team on standby ready to assist you if at any time during our discussion you have a question or would like clarification on a point. Just click on the Q&A icon, which is the third button from the left at the bottom of your screen. That will allow you to send in your questions. We will do our best to answer your questions in the allotted time we're given. If your question is not answered, please follow up with your Edward Jones financial advisor. If you don't have an Edward Jones financial advisor, please click on the Find an FA widget below. We also have a lot of helpful resources and information available for you inside the resources icon, which is located next to the Q&A icon. All right, now that you know your way around, let's get started. There's no time like the present to better understand financial concepts that you can apply them to your personal situation. Our panel of experts will review key components of building an emergency fund, navigating debt, and preparing for retirement so that you can build a financial strategy that makes sense for your needs. Today, we're joined by Edward Jones Senior Strategist in Client Needs Research, Megan Dow, Senior Analyst in Client Needs Research, Zach Gildehouse, and Edward Jones Financial Advisor, Adela Hunter. And thank you all for joining me today. Adela, let's start with you. What are some examples of questions that clients may be worried about asking?
I try to create a comfortable environment during our time together to ensure that our clients feel comfortable asking financial questions they may have. Even though managing money is something we all do on almost daily basis, or at least consistently, it's not a topic that was consistently taught in schools. So it's understandable that many of us have gaps in different levels of financial knowledge. Sometimes it's simply not knowing the terminology, like what is an interest rate or APY, which stands for annual percentage yield. Other times it's just wanting help understanding choices like the difference between contributing to a traditional versus Roth retirement account. I'm hoping that today we could touch upon a lot of these topics to help everyone build that financial foundation of financial literacy that can help set them up for success.
All right, let's start with terminology. To get everyone on the same page, what are some key concepts investors should familiarize themselves with?
By understanding these terms, investors can work with their financial advisor to tailor them to their personal financial goals. The first concept I'd like to touch on is interest rates. These have been in the news a lot lately because they've been increasing. Simply put, interest rates are how much someone charges to lend money. It's usually expressed as a percentage of the total amount borrowed. For borrowers, the interest rate can be thought of as the cost of borrowing money, so lower is better. For savers, it's the return you can expect to get when you put your money into things like a savings account, CDs, or even bonds. So savers tend to favor higher interest rates. The other term that's been in the headlines lately is inflation, which we've heard a lot about in the past year or so because it's picked up quite a bit. Inflation is essentially just prices increasing over time. So it describes the phenomenon of a dozen eggs being so much more expensive than they were just a year ago. When it's reported in the headlines, it's generally the increasing cost of goods and services across the entire economy. One thing to note is modest inflation is a normal part of a healthy economy. Based on recent headlines, you may think that no inflation or even negative inflation is good, but a healthy, growing economy has some level of inflation. You just don't want too much or too little. Next up is the concept of time value of money. The idea here is that money today is worth more than the same amount of money in the future, both because it can buy more, remember inflation, and you have the opportunity to invest it and earn a return. Remember interest rates. This is an incredibly powerful idea, And the reason why saving early and giving your money time to grow is so impactful. So if you were to put $5,000 into a retirement account and get 6% return, in 25 years, it could grow to $21,000. Lastly, let's do some quick hits on some jargon that comes up a lot when we're working with clients. First up is income. Income is the money you have coming in over a period of time. You may talk about your weekly, monthly, or even your annual income. We all tend to think about income from our jobs, but it may come from other places like your investment portfolio. Next term is expenses. Expenses are what you spend. Sometimes we break them into required spending, things like housing, transportation, or food. Or we break them into non-required, or what we might call discretionary spending. These are things like entertainment or travel, for instance. The next term is cash flow. Cash flow is your income minus your expenses. If your expenses are more than your income, you're going to run into problems down the road. If your income is more than your expenses, you should be able to save some money for the future. The next term is assets. Assets can be thought of as something you own that has transferable value, meaning you could sell it for money or trade it for something else. This could be something like a house, an investment, or even a baseball card collection. The next term is liabilities. Liabilities are essentially debt or money that you owe. This could be a house loan, a credit card balance, or money you owe for medical services. And the last term is net worth. Net worth is what you get when you add up all of your assets and subtract all of your liabilities. Another way to say this is your net worth is what would be left if you used all of your assets to pay off all of your liabilities.
Adela, how do these terms apply to how someone should approach budgeting?
Many people think of limits when they hear the word budget, but it actually puts you in control. Once you understand the income and required expenses you're working with, you can better outline how much you should be spending, saving, and investing each month to help you reach your goals. To get started on budgeting, we recommend using tools you're most comfortable with. It can be a spreadsheet, budgeting app, or even as simple as pen and paper. Get to the level of detail that works best for you. Some people just want to track their income and expenses, while others want to get much more detailed. The important thing is to find the approach that works for you. Next, look for ways to align your spending with what you actually value. The idea is to get the most value and enjoyment out of the money you spend. One thing I see all the time is people paying for subscriptions they no longer use. Eliminating some of the unnecessary spending gives you control over your budget. An alternative to cutting expenses entirely is looking for substitutions. For example, if you're paying for a premium gym membership, but you find that you no longer attend group exercise classes, see if you have the option to switch to a different tier membership that may cost less and save you some money. This can allow you to still get the enjoyment of utilizing the services and products versus completely forgoing things that you enjoy. The point is to take an inventory of your spending and see if it aligns with your personal and financial goals.
Megan, once someone has their budget mapped out, what do you think is an important next step?
Budgets are great for planning for our expected expenses, but most of us also have experiences with unexpected expenses as well. For example, my family got surprised by some unexpected medical bills just a few weeks ago. When these pop up, an emergency fund is an incredibly helpful tool. Let's go back to terminology. What is an emergency fund? It's money you set aside to prepare for something unexpected. Job loss, needing to take unpaid leave, your car breaking down, or a trip to an emergency room or urgent care. Now, we generally recommend people hold 3 to 6 months in an emergency fund. But if you're not there, that's okay. Even smaller amounts can be extremely beneficial in helping you weather an unexpected expense. We recommend keeping your emergency savings in a separate account from your everyday spending money. It should be in a savings account and readily accessible. You don't want to risk having it go down in value at the same time you need it. You also don't want to pay a penalty to access it.
What about debt? I think many people consider that an ugly word, but is all debt bad debt?
No, Sandy, it's not. I know Megan's in the process of buying a new house, and while I know she personally really tries to avoid debt, I guarantee she doesn't think the mortgage she's taking out is a bad thing. Loans, when used properly, enable a lot of life's milestones. In addition to buying a house, that could look like paying for college or even buying a car. When we think about good debt, it generally has a few characteristics, but it doesn't necessarily have to have all of these to be considered good debt. Number one, it has low interest rate. It's a bonus if that interest rate is tax deductible. Number two, it's used to buy something that has value, may increase in value, or will help you generate income. And number three, it doesn't push your total debt levels too high. Bad debt is just the other side of that coin. And these are the loans we suggest you try to pay off first. Number one, it has high interest rate. Number two, it's used for something that doesn't have future value. And three, it pushes your total monthly loan payments, not including your mortgage, to more than 20% of your monthly income.
When we start talking about debt, we get a lot of questions about credit scores. Can you talk a bit about those?
Yeah, this is one we hear a lot. Credit scores are scores assigned to every person based on your perceived ability to repay a loan. It can affect whether you qualify for a loan, how much money you get when applying for a loan, and what interest rate you're charged. Credit scores range from 300 up to 850, with anything above 670 generally considered good. Now, there are many factors that impact your credit score, and there are a few different organizations that provide them. That said, here are a few of the factors impacting your credit score in the order of importance. Number one, your payment history over the last 10 years. Now, the more consistently you've made payments over that time, the better. Number two, how much you currently owe and how much of your available loans you're using. The takeaway here is the less you owe, the better. Number three, how long you've been using loans. The longer you've responsibly been using loans, the better. Number four, how many different types of loans you have. Now, this is going to sound a little counterintuitive. I know I just told you less debt is better, but they want to see you've been able to manage various types of loans. The more types of loans you have, the better it is for your credit score. So having a car loan, a house loan, and a credit card would be viewed more favorably than having just credit card debt. And number five, have you taken out new loans recently? If you've taken on a lot of new debt, it's generally not viewed favorably. Now, one more thing on debt, making just minimum payments on credit cards makes it very difficult to pay them off. Based on analysis done by Edward Jones, you may end up paying as much as double the original purchase price and interest costs, and depending on the balance, it can take years to pay off.
Let's better understand the questions investors have regarding retirement.
There are so many. Some of the most common ones include, what should I know about my 401k versus an IRA? What's the difference between a Roth and traditional retirement account? And how much should I be saving for retirement? A 401k is the type of employer retirement plan. We also commonly see 403bs offered by institutions like universities, public schools, and nonprofits. These are plans through your employer that offer tax-advantaged accounts where you could save for retirement. Not every employer offers them, however, and even those that have access, they may want an IRA, which stands for Individual Retirement Account. Like a 401k or a 403b, it is a tax-advantaged account intended to help you save for retirement, but it is not related to your employer. Both traditional and Roth retirement accounts offer tax benefits just on opposite sides of the equation. Traditional retirement accounts offer tax benefits on the contribution, while Roth retirement accounts offer the tax benefit on the distributions. Both allow funds to grow tax deferred while being held in the account. For the last question on how much you should save for retirement, I get this question a lot from my clients. There's no one-size-fits-all answer. And as your financial advisor, it is my job to work with each client, family, or household to ensure that we come up with the right answer and approach that is customized to their personal needs and unique situation. But Zach, I know you have some rules of thumb. Do you mind sharing them?
Sure. A strong start is making sure you're getting any employer match available to you. With these matching programs, your employer matches your contributions to your health savings account, also referred to as your HSA, and or your retirement account up to a certain amount. It's essentially free money. So it's a very powerful tool in helping you prepare for retirement. One thing to keep in mind is that some employer plans have what's called a vesting period. This is a period of time you must continue working for the employer before you actually own the employer's contribution to your plan. A couple of points here. HSAs aren't subject to vesting, so both your contributions and your employer's are immediately yours to keep. For your retirement plans, if you leave the company before you're vested, you will forfeit the employer's contribution to your retirement account. That said, you are always 100% vested in your salary deferral contributions, or said another way, you won't have to forfeit any of the money you put into the account if you leave. Many people don't have the benefit of an employer match. And even for those who do, it may not be enough to get them on track for retirement. If you can, try to increase your contributions each year. Earmark at least a portion of any raises to go to your retirement savings. A good rule of thumb is saving 10 to 15% of your gross income, meaning your income before taxes. As Adela mentioned, a financial advisor can give you a much more personalized savings goal.
You mentioned HSAs. Megan, what should clients know about HSAs?
HSAs are great tools not only for healthcare, but also retirement. Not everyone can contribute to an HSA, but because more employers are offering what's known as a high deductible healthcare plan, more and more people are gaining access to them. Now, these are often confused with flexible spending accounts, or FSAs, which are use it or lose it accounts. Unlike an FSA, the amounts saved in the HSA are portable, meaning if you leave your employer, you can take them with you, and they roll over from year to year. So the amounts you contribute and don't spend can grow. Speaking of that, most allow you to invest some portion of the funds so you can benefit from the growth potential of investing. And Zach already mentioned that contributed amounts, whether from you or an employer match, are automatically vested, so they're yours to keep. I mentioned them being a great tool for retirement, so we spend just a minute on that. One of the largest expenses most families have in retirement is healthcare. And this is an account that can help cover those expenses in an extremely tax-efficient way. With traditional retirement accounts, you owe income tax on distributions, while with Roth accounts, you pay taxes on your contributions. Basically, you owe tax on one side of the equation. If you use HSAs for qualified healthcare expenses, you never pay taxes on those funds. So if you let funds accumulate in your HSA, you will have a dedicated account to pay for many of your healthcare expenses in retirement, tax-free.
That makes sense. Adela, we've seen a lot of volatility already this year. How are investors coping, and what do they need to understand about normal fluctuations in the market?
You are correct, Sandy. We have seen a lot of volatility. I remind my clients that market fluctuation is not abnormal. I try to remind them that there's a reason we built a well-diversified portfolio with quality investments to weather the volatility. We also discuss, if appropriate, investing further into the market during some of the dips we have seen already this year. Normal fluctuation is to be expected as we navigate global economy, political landscape, and events that happen domestically in the U.S. I remind my clients that we do not want to be reactive to their long-term financial strategy. Instead, we talk through their concerns and emotions, and then we see if an adjustment seems fit.
Megan, how does Edward Jones account for market volatility and the anxiety that goes along with it in an investor's financial strategy?
At Edward Jones, we try to do what I call robust investing. Merriam-Webster defines robust as capable of performing without failure under a wide range of conditions. When it comes to investing, that means we try to design portfolios that will perform well in a variety of different types of market environments. How do we do that? Well, first, we try to make sure you're taking the right amount of risk for you. Second, we try to ensure your portfolio is properly diversified. And lastly, we work with you to make adjustments as needed over time. Let's start with that first one. When it comes to taking the right amount of risk for you, we look at 3 lenses of risk. The first one is risk tolerance. I call this pain tolerance because it's essentially how much investment pain you're willing to tolerate. Some people can watch their investments lose half their value and still stay invested. Others lose sleep over almost any decline. It's just a measure of kind of where you fall on that spectrum. Second is your risk capacity. We look at things like when you'll need this money, it's called your time horizon, and how much you'll need, it's called your liquidity needs. So for instance, when you near retirement, you should likely start taking less risk than when you're a decade or more away. Because a downturn right when you retire and start withdrawing your savings can be really detrimental. The last lens of risk that we use is your required risk. This is how much risk you need to be able to achieve your goals. Most of us have heard the adage, no risk, no return. Generally, what we expect in finance is the more risk you take, the higher return you can expect over time. So once we have a better understanding of those lenses of risk and what we're targeting, then we look to build a diversified portfolio. And this really comes down to 2 key pieces. 1, own investments that act differently. And 2, don't own too much of any one thing. I was an avid hiker, so I really like to use a hiking analogy for this. On a multi-day trek, you never know what conditions you'll face. And in many places, the weather can change on a dime. So when I'm packing my hiking bag, I include things for sunny weather, but also gear in case it's rainy or cold or otherwise treacherous. Those treacherous days can be less comfortable, but when I have my hiking boots and my waterproof gear, I know I can keep making progress. We try to build portfolios the same way, not just using investments that do well when the economy is humming along, but also investments that tend to hold up better in choppy markets. That will not guarantee you won't have a loss in your portfolio, but properly diversifying generally means the overall experience is a smoother ride. Lastly, I can't think of anything in managing money that should be one and done. Life changes as well as the market, which means we often need to make adjustments along the way. So we work with you to help ensure you're staying on track.
Any final thoughts?
I know we've covered a lot of stuff today. My hope is that it helps you feel more informed and in control of your financial picture. But if your head is spinning a little, that's okay. You don't have to go it alone. We don't expect you to be a financial guru after just one webinar. A financial advisor can help fill in the blanks. They're there to help you make financial decisions that are aligned to your goals and your unique situation.
Adela mentioned that a lot of this isn't consistently a part of our education curriculum, and that really resonates with me because I didn't learn any of this in high school. It wasn't until I majored in finance that a lot of these concepts came up. So my main parting thought is don't feel bad if there's anything you don't know. I have a 2-year-old right now, and one of my life goals is to approach learning like he does, with joy and curiosity, and know that we're here to help you answer any questions and fill in any gaps.
Exactly. Part of our job as a financial advisor is to be a source of answers to your questions, both the ones we've covered today and any additional ones that you'd like to learn more about. So never hesitate to reach out.
Thank you all so much for your time today and for sharing your knowledge and insight. We appreciate it. As I mentioned earlier, we have several resources that we hope will help you during this time. Be sure to check them out by going to the resource icon on your screen. We're now going to start the Q&A portion of the program. We have a team of subject matter experts waiting online to answer your questions through the Q&A widget. Please remember that there will not be any video during this portion. You will only see a slide prompting you that the Q&A is now in session. But rest assured, the webinar is still live. We will do our best to answer your questions during the allotted time. If your question is not answered, please follow up with your Edward Jones financial advisor. If you don't have an Edward Jones financial advisor, please click on the Find an FA widget below. I also want to remind you that this broadcast will be available again on demand using the same link you used to register for today's program. Please note our upcoming webinar as well. Thanks again for joining us, and please enjoy the rest of your day.